My name is Charles Aite. Let's start with our first story because this hour, economist and finance lecturer at the Valley University, Dr. William Chepra, is making a case for government to raise interest rates as a buffer against the continuous fall of the cedi. He joins us for more on this. We're grateful Dr. could join us. You're calling for hikes in interest rates to balance the free fall of the cedi. Why?
Good afternoon to you and to your viewers. Thank you very much for calling me. I'm just going to, this assertion that I've made is just based on purely what has been done in the books and what is the practice normally done in elsewhere in other economies. So for almost 2 years now, as a country, we have gone against three main international principles when it comes to finance. There is the first one we call the purchase power parity. The second one is the interest rate parity. And the third one is international features effect. These principles are what are used in explaining how exchange rates moves in the world, especially in international financial trade. So in Ghana, for the past 2 years, we have not been able to align the forex exchange rates with the Bank of Ghana exchange rate. So we create a room for what we call arbitrage situation. Once there's an arbitrage situation, somebody who is economically wiser, like myself, I will go and use Ghana cedi and purchase foreign currency and just keep, knowing that I'll get a higher margin on the foreign currency by holding it. So that is what has happened now. The 8% increase or depreciation or devaluation of the cedi against the dollar means that anybody who is holding foreign currency has gained 8.86% on that foreign currency. The only solution to solve it is that government must come out with a plan that will make sure that people will not be interested in holding foreign currency. And the way to do it is you raise your interest rate within the country, especially treasury bill rates, bond rates, the monetary policy rates. All of them must be raised a little higher to make our investment portfolios active.
I'm afraid we have lost Dr. William Chepra there, but he's been making a point regarding how best to shore up the competitiveness of the cedi, calling for a raise in the interest rates to create somewhat of a buffer for those holding foreign currencies, especially when we continue to see an 8% depreciation of the cedi. We'll try and raise him up, especially when others are arguing that the increase in interest rates at this time, when prices of goods and services are already skyrocketing, could be insensitive to the average Ghanaian. We'll try and raise Dr. Chepra up once again to get the exact appreciation of his argument on the depreciation of the cedi. As Chief Finance Officer of the Valley University, Dr. William Chepra has been proposing an increase in interest rates to buffer the free fall. Dr. William Chepra, we're grateful that I could reconnect once again. But even though you get back to your main point, others are going to make the argument that could this not be an insensitive move by government, especially when the average Ghanaian is already feeling the pinch of the cedi's depreciation?
Thank you very much. So an increase in the interest rate, when I say interest rate, that is investment rate, is even an incentive for Ghanaians that now don't hold foreign currency. Come and hold government instruments or investment. So if you are not interested in holding government treasury bill, you go and hold government treasury bill. Also, this is the time that government needs money. So the only way government can entice Ghanaians to bring in more money so that government can use to run its operation is to use the interest rate, accept higher interest rates. This, to me, solves the problem of government not having money. It solves the problem of people holding or investing in foreign currencies instead of investing in government securities. And then in that effect, it will reduce the rate of the demand on the foreign exchange. And in effect, it will make sure that there is a reduction in exchange. In fact, the impact of exchange rate in the books, when we say in the books, what has been researched, is greater than even if you have an impact on what we call inflation, because the underlying of inflation, especially like a country like Ghana where we import everything, is that you are importing other countries' inflation into your country. You are worsening or devaluing your currency. So this is the only way out, as I see it, for government. I am expecting Bank of Ghana to have a higher monetary policy rate, which will trickle down on investment rate. The only effect or negative effect I see this is that it's going to slow down the economy because banks will not be lending to companies because they will also be investing their money into government securities because that is more risk-free. That is the only challenge I see that will come. But comparing the rate of the free flow of the exchange rate, it is better to slow down the economy, the rate of growth, than to weakening our currency.
It's interesting that you were, rightly, on point when you stated the risk involved with this particular, reform. But do you see things getting normal for the city in the short to medium term? If so, why?
I mean, I don't see this fall stopping. This has been the trend for the country. If you look at our exchange rate and performance, all the time, the first quarter, we see our currency devaluing in the first quarter. In the past, all the multinationals were transferring their dividends somewhere at the end of March, April. But now we see, I'm going to mention one company, MTN, who is going to declare about $1.5 billion of dividends to be paid to its shareholders. MTN is projecting that they are going to pay it in June. So in June, if government, we don't have dollars in the system to help MTN to transfer to their shareholders in South Africa, it's going to be worse. So I see this issue happening up until June, where we are sure that government may have to negotiate, or Bank of Ghana may have to negotiate with all the multinationals in the country that in the repatriation of your dividends, let's have a plan so that you don't disrupt the economy. Because if they demand more foreign currency, it's going to weaken the city. So this, in the short term, this is going to be with us somewhere until mid of second quarter, and after June, that we really see how government will. Normally, by June, we will be receiving the cocoa syndication loans. So I'm hoping that by June, the cocoa syndication loans for about 1.5 billion should come in, which will offset whatever pressure that will come on the city during June. Then that will make sure that we are in. So if we are also, we find a situation that cocoa syndication loans will not come in June, then the problem is going to be very difficult for us as the country.
And that's going to be unprecedented, especially when we continue to track the successful, dishing out of the syndication loan to Ghana.